By the time the volume turned violent, the damage had already been done, not to the market, to the people who had just sold. I remember the exact moment it happened. It was late evening in the US, the kind of quiet trading window when most retail investors aren't paying attention. The chart looked weak. XRP had dipped again, sliding slowly through levels that had once looked like strong support. Red candles, thin volume, a tired market. Social media was brutal that day. Dead coin. Another fake rally incoming. Smart money already left. I've seen this movie before. When markets move sideways long enough, people stop thinking strategically and start reacting emotionally. The dip begins to feel permanent. Every bounce feels suspicious, and that's exactly when the market becomes dangerous. Because while retail traders were arguing online, something strange was happening underneath the surface. I noticed it first in the order books. Sell pressure looked real, but it wasn't moving price the way it should have. Large chunks of XRP were being sold, yet the market wasn't collapsing. Instead, the dips kept getting absorbed quietly. No excitement, just silent buyers. Then I checked the volume data. That's when the pattern became impossible to ignore. Large blocks of XRP were changing hands, not in dramatic spikes but in steady waves. The kind of volume that doesn't appear unless serious money is involved. And the timing was uncomfortable, because that accumulation phase started right after retail sentiment turned extremely negative. Then suddenly, the chart flipped, volume exploded, liquidity vanished, price launched upward like someone had pulled a hidden lever. The same traders who mocked the dip hours earlier were now staring at green candles in disbelief. But after digging through the data that night, one realization kept bothering me. That violent move didn't start when the volume appeared. It started earlier. Much earlier, right when the market convinced everyone the dip was real. And that raises a question nobody seems to be asking. Who was quietly buying while everyone else was laughing? I noticed the shift in mood before the price move ever happened. It wasn't on the chart, it was in the conversation. That morning, sentiment around XRP had reached a strange level of exhaustion. Not panic, not excitement, something worse, indifference. Traders weren't even arguing anymore. They were dismissing the asset entirely. Comments across trading forums and social feeds sounded identical. Nothing moves anymore. Better opportunities elsewhere. This market is finished. When sentiment reaches that stage, something important happens. Liquidity starts disappearing. Investors stop placing buy orders because they assume lower prices are coming. Sellers become more aggressive because they want to exit before things get worse. On the surface, that kind of environment should push price down quickly. But that's not what I saw happening. Instead, every dip seemed strangely controlled. The price would fall, pause, then stabilize. It felt unnatural, almost like the market was being guided downward just enough to trigger selling, but not enough to collapse completely. I've watched markets for years now, and that pattern always makes me uncomfortable because it suggests something specific, not panic, positioning. Someone was allowing the price to drift lower while quietly absorbing everything the market was throwing at them, and if that's what was happening, then the real story wasn't the dip, it was who was waiting underneath it. That suspicion pushed me toward the blockchain. When price action feels strange, I look at wallet activity. Numbers don't carry emotions, they just record behavior. And the behavior I found was interesting. Several large XRP wallets had become active within the same 48-hour window. These weren't small traders moving a few thousand tokens. These addresses held millions, sometimes tens of millions, of XRP. Normally, when whales move funds during a market dip, the assumption is simple. They're preparing to sell. But the destination of those funds told a different story. They weren't going to exchanges. They were leaving them. Tokens were being withdrawn into private wallets and long-term storage addresses, the kind of wallets investors use when they don't plan to sell anytime soon. That detail matters more than most people realize. When large investors remove assets from exchanges, they reduce the available supply that traders can actually buy or sell. Less supply means something important happens when demand eventually returns, price moves faster, and the timing of those withdrawals was suspiciously perfect. They began just as retail sentiment collapsed, just as the market convinced itself the dip was real, which means whoever controlled those wallets wasn't reacting to fear. They were using it. What most traders saw during the dip looked like weakness, but when I studied the order books more closely, something else appeared. Liquidity gaps. Sell orders looked heavy on the surface, but they weren't stable. Large walls would appear, push price slightly lower, then disappear once selling pressure intensified. That pattern creates an illusion. Retail traders believe the market is collapsing because they see the price dropping quickly. In reality, those drops are being engineered inside thin liquidity zones. When liquidity disappears, even small orders can move the market dramatically, and that's exactly what seemed to be happening with XRP. The dip wasn't a flood of sellers overwhelming buyers, it was a market drifting through empty space. Meanwhile, patient capital was sitting underneath, quietly absorbing whatever supply appeared. This type of environment creates something traders rarely recognize in real time, a liquidity trap, and once enough supply has been absorbed, the trap snaps. The breakout began quietly. At first, it looked like a routine bounce. Price recovered a few percentage points and traders barely noticed. Then, the volume arrived. Not gradual, not subtle, violent. Large buy orders started hitting the market in rapid succession. Liquidity above price vanished as sellers pulled their offers. The chart began moving upward faster than most traders could react. Short sellers were the first to panic. Liquidations started triggering automatically as price pushed through key resistance levels. Each liquidation created another buy order, which pushed price even higher. Within minutes, the market had transformed. The same asset that looked weak hours earlier suddenly looked unstoppable, and retail traders who had mocked the dip were now chasing the rally. But the more I watched the chart that night, the more one thing became clear. This wasn't random volatility. It was the release of pressure that had been building quietly for days. As the rally continued, I started watching something most retail traders ignore: derivatives markets. Open interest in XRP futures began rising quickly, but not chaotically. Positions were building steadily rather than exploding all at once. That pattern often suggests participation from larger players. Institutions don't chase volatility emotionally. They scale positions carefully, building exposure over time, and several signals hinted that kind of activity might be happening. Volume spikes during U.S. trading hours, stable funding rates, controlled liquidation levels. None of these signals prove institutional involvement on their own, but together they create a pattern, one that suggests the rally might not have been driven purely by retail excitement. Sometimes markets move because of hype. Other times they move because serious capital has started paying attention again. And the deeper I looked into the timing of the XRP rally, the more the second explanation started making sense. Around the same time this accumulation appeared, something subtle was shifting in the regulatory environment. Not a dramatic announcement, just a change in tone. Recent conversations around digital asset regulation had become slightly less hostile. Lawmakers were speaking more about frameworks and clarity rather than outright restrictions. For most traders, those comments sounded boring, but for large investors managing billions of dollars, regulatory clarity changes everything. If the perceived legal risk surrounding an asset begins to decline, institutions start evaluating opportunities that previously felt too dangerous. XRP has lived under that regulatory shadow for years, so even a small shift in legal expectations can dramatically change how sophisticated investors view the asset. Markets don't wait for official decisions. They react to probabilities. And sometimes the biggest moves begin when those probabilities quietly start changing. By the time the volume turned violent, the damage had already been done, not to the market, but to the people who had just sold. I remember the moment clearly. It was late evening in the United States, the quiet stretch of the trading day when most retail investors aren't watching closely. The chart looked tired. XRP had dipped again, sliding through levels that once looked like solid support. Red candles stacked slowly on the screen. Volume was thin. The entire market felt exhausted. Social media was brutal that day. Dead coin, another fake rally. Smart money already left. I've watched markets long enough to recognize this stage. When prices move sideways for too long, strategy disappears and emotion takes over. Investors stop analyzing signals and start reacting to frustration. Every bounce feels temporary, every dip feels permanent, and that's when markets become the most dangerous, Because while retail traders were arguing online, something unusual was happening beneath the surface. The selling looked real, but the price wasn't collapsing the way it should have. Large chunks of XRP were hitting the market, yet the dips kept getting absorbed quietly. No excitement, no headlines, just silent buyers taking everything the market was throwing at them. So I started digging deeper. The blockchain told a different story. Several large XRP wallets became active during the same 48-hour window, but instead of sending coins to exchanges to sell, they were withdrawing them. Millions of tokens moving into private wallets and cold storage, the kind of move investors make when they expect to hold for a long time. At the same time, liquidity on exchanges was thinning. Sell walls appeared and disappeared, creating the illusion of weakness while patient capital quietly accumulated supply. Then suddenly, the pressure released, volume exploded, liquidity above the market vanished, price surged upward as short sellers were forced to cover and late buyers rushed back in. Within minutes, the narrative flipped. But the more I studied the data that night, the more one truth became impossible to ignore. The rally didn't begin when the volume exploded. It began earlier, when the market convinced everyone the dip was real. And that raises the question most investors still aren't asking. Who was quietly accumulating XRP while everyone else was laughing?